Okay, so today we're going to touch on two or three different topics. The first is variance, and I'm for simplicity purposes, we're going to avoid the better part of some of the math in terms of variance, some of the calculations that an exotics desk would use to think about variance, to basically stick to um, how it varies from listed options, why people trade it, what the pros and cons of it are, and ultimately, since we're an agency desk, how we can replicate the variance in listed form and the advantages of doing so. So, first and foremost, why do people trade variance? The first reason that people trade it is for convexity reasons. What do I mean about convexity? Well, I'll get into the calculation about it, but what it basically means is that um, variance includes squared returns of volatility. So what effectively happens is that as volatility picks up or as stock markets move lower, you get more bang for your buck or more realized variance when you um, move lower. So it's a way to get that convexity or the true explosion that you would see like in the VIX, for instance. It's one of the reasons why the VIX can move so quickly. The same thing can happen in terms of variance, because variance in and of itself is supposed to be representative of the VIX. Now, in actuality, variance and the VIX have differences, which vol desks are about, and we don't need to get into that here. But for all intents and purposes, the first point of variance is that it has massive convexity, which is beneficial in particular when you're buying it. The second reason that people trade it, which is a big reason on the street, is that you don't need to daily delta hedge the trade. What that means is that obviously if you want long volatility and exposure in a name, and you want to maintain that long volatility exposure and not a delta bet, you would normally have to daily delta hedge a option to keep that flat delta long volatility exposure day to day. With variance, you don't have to do anything to the position. The way variance works is that basically every day your position resets and you capture the realized volatility squared of that day. Um, so that's a big advantage for some people, particularly those who don't want to manage a delta position. But that's one reason why they trade it. Now you might ask, how are they able to manage that volatility, or how are they able to capture that delta without having to daily delta hedge? The reason for that is that variance has constant gamma exposure. So I want to move to a different slide here to talk about that. So if you were to look at um, either chart 1 or chart 3 here, just you could pick any of these curves here, these bell-shaped curves, to think about the gamma of a position. Obviously, as we talked about in the past, gamma is highest at the money in a position. And as you move further away from a strike, your gamma typically decreases. So if you use this blue line here in chart 1, which is the 120 strike, obviously as you move up to 140, your gamma decreases, and as you move down to 100, your gamma decreases. When your gamma decreases, ultimately your volatility exposure to a given name decreases. Again, as gamma decreases, it means that your delta sensitivity decreases, meaning that for movements in the stock, there's less delta to trade because there's less probability that the options either finish in or out of the money. So that's problematic if you want to maintain long volatility exposure to a given name, but don't want to make a bet on where the spot is going to be on the name. So the simplest way to think about variance in terms of comparing it to listed form is to think about variance being a strip of a ton of options, owning every downside put and owning every upside call in a name, so that every day when the stock moves, regardless of where you move, your gamma is constant. If your gamma is constant, then you don't have to worry about moving away from your exposure. So that's one big difference there, in that there's constant gamma. Now, how do you get constant gamma in a portfolio of options, or how do you get to the point at which talking about replicating in listed form? Again, using the example of um, at the money versus out of the money options. An at the money option is going to have more gamma than an out of the money option. So to keep constant gamma, you're going to have to buy a lot more out of the money options, particularly on the put side, than you have to buy at the money options. So that's again another place where the convexity kicks in. To keep that constant gamma weighting, you have to have more contracts on the downside. So what that means is that if the market were to move to the downside in listed form, you would start to pick up gamma, or you would start to pick up long volatility exposure or convexity as you approach the strike. Again, that's in the listed form, but the same holds true when you're talking about it in OTC form. So the way that people replicate variance in terms of listed form, mathematically, the way to think about it is that looking at chart 4, it's basically weighted as 1 over the strike squared um, to maintain that gamma exposure. So you can see here that the position would maintain $1 gamma regardless of the strike, whereas in the other instances, if you have constant weighting, your gamma would pick up as the strike moves higher. I know that can be a little bit confusing. Going back to the first, oh, someone's asking a question here. Repeat the last statement. Okay, so if you look at chart 4, that basically visually displays what the dollar gamma exposure of variance will look like, and how it's calculated. If you look at the straight black line, it's what the gamma would look like as a stock moves across the strike, and the underlying changes. The point there, and again, I'm trying to keep it as simple as possible. The point is that your gamma is always going to be the same in variance. You're always going to have the same amount of exposure. It's not like a listed option where gamma gets, if you're having at the money option and it's 1 day till expiry, you have a tremendous amount of gamma. It's always going to be constant, and you're always going to have the same potential to realize every single day. So it is the purest form of capturing realized volatility. The other two lines in here are related to weighting, a constant weighting, and also 1 over the strike weighting. I'm not going to go into detail on that because it will just complicate the situation more for you. The key thing to remember, though, is that gamma is basically consistent across all strikes in variance, and that's why you always maintain the long volatility exposure regardless of where you are on the stock's underlying. Does that make more sense? Okay. The other reason why people trade variance is that it's additive. And I've spoken about options being additive and risks changing as volatility changes, but this is absolutely more or most pertinent and relevant in terms of variance. When you trade a listed option and let's say you traded at a 20 implied volatility. If the stock doesn't move, but the volatility goes from 20 to 40, well, your risk just doubled on that position. The implied vol went up, the premium went up. If you were short it, it doubled against you. If you're long it, you have more to risk now, even though you made money. But generally speaking, you don't have volatility change drastically without the underlying moving. And again, the issue that I presented before, that oftentimes the underlying will move away from your strike and you'll move away from your gamma exposure. If you move significantly away from your gamma exposure, the volatility move is less relevant. In variance, because you have that constant gamma, the volatility movement or the additive nature of it is much more relevant, and it's a way to, again, sort of get that tail exposure. In terms of concerns about trading variance, from my experiences, generally speaking, it's like any other OTC product. You have the same sort of counterparty risks that you would have in with any other OTC trade. In 2008, for instance, and even 2011, the margin requirements shot through the roof and actually forced a lot of vol guys out of positions because the banks basically held their OTC products and could stop them out of positions. So that's one concern you have. Another concern is that, again, because variance is not marked by a clearinghouse like listed options are, the banks can pretty much market wherever they want. Now, based on how your fund does things, you obviously tend to use the average of where banks mark things. But when shit hits the fan, per se, they certainly tend to sort of collude and mark the trades against you. And then finally, I think a lot of people who trade it don't really understand the convexity aspect of it and the additive nature of it, whether they're buying the variance or selling the variance, and that's certainly one reason to be wary of it. Slide 2, I kind of already covered. There's a link on this slide, and I can also send it to you guys if you want. There's an old note that JP Morgan put out, I don't know, like 10 years ago or something, that really sort of digs into variance, the Greek exposures, how to replicate it. I'd rather you guys go into detail on your own because it's really long and there's a tremendous amount there. I can obviously help or answer questions on it if you have them on the topic, but I would certainly go to there. In terms of how we can trade variance or replicate it for someone, let me see if I can bring up an Excel spreadsheet here. Give me 1 second. Can you all see my Excel spreadsheet here? Hopefully. Yes? If not, someone speak up. Okay, great. So this is an example. This is like a spreadsheet that I built here that which would effectively show how we could replicate variance for a customer of ours. So in this instance, I was looking at SPX expiring in April, and effectively, loaded all the strikes in here in SPX again, because you're going to be, buying what's called a strip of options to replicate that. And based on some of the calculations that we don't get into detail on, can then reach a target vega or target variance unit. I'm not going to talk about variance units because, again, it's just going to complicate things. But The point here, though, is that as you can see, as you move further down into lower strike options, you're buying more contracts than you're buying um, at the money options. It's not going to look as interesting when you're talking about SPX because there's a larger multiplier there than on SPY. But you can see that as you move down to the put wing, you're long much more of those tail wings to keep that constant gamma exposure. And that's again where we talk about the convexity. So what we can do for people is they can say, I want to buy 100,000 Vega of April SPX variance, and we can effectively load a strip like this, and we can more or less create it for them in a listed form, so they don't have to deal with the banks. Now, the reasons why they would potentially do it with us versus a bank, I kind of already touched on. If they truly are concerned about some sort of credit OTC issue with a particular bank, if they don't like the margin they're getting from a bank, actually at my last job they were not, by for whatever reason, the firm was not allowed to trade variance, so I had to replicate variance in listed form. Some investors just don't like it. It scares them. They've heard of people getting blown out in it. So you can make the argument that you're actually trading listed options. You're just trading a strip of them. Um, and the other thing too is that you could certainly pick and choose your strikes a little bit more. For instance, where I used to work, I would um, stop the strip at a certain level because I just didn't want that convexity exposure, and basically clipped off the wings in terms of the variance. So you can get cute with constructing your position that way. But again, those are a few reasons why we would potentially trade those in listed form for people. I'm going to go back to the PowerPoint. Are there any questions so far on variance? I could talk about it for a long time, but I don't want to get into the nitty gritty and confuse people if it's Um, so in terms of, sure, I can explain the liquidity of the VAR market. So in '08, for instance, or prior to '08, a lot of vol desks traded a good amount of their volatility exposure in variance form, whether it was single stock, commodity. I mean, you could have bought an oil variance, or index. It was fairly liquid. You could have probably traded, S&P variance, a tenth to zero point 0.2 vols wide, 100 to 2,000 Vega up in 2008. So it was incredibly liquid. It was easy to manage. Again, from a delta perspective, you didn't need to delta hedge it every day, and you had the exposure that you wanted. Like I said, in '08, you had issues with mark to market, banks marking things in your face, taking haircuts on positions um, you were up on versus positions you were down on, and it really created a problem for the variance market, and it pushed a lot of investors out of the variance market because of these reasons, and some never came back. Some have come back. What ended up happening is, for a while, um, banks would start trading index again. So I would say maybe in 2010, 2009, 2010, banks got active again on index variance, but weren't trading single stock variance. And one of the things that they did is start capping variance. So the idea of capping variance, simply put, is, let's say you sell S&P S&P VAR at 20, and you have a 2.5 cap on it. That means that that at what would that be, at 50 vol, your position would be capped out. And the reason that banks did this again is because they got hurt as well in 2008. So it was basically like sort of stripping out some of the convexity to take their risk parameters down. Another thing that they started to do, which they tried to get to catch on, but it never really did, at least not in my opinion, is trade vol swaps. Um, Vol swaps are similar to variance swaps. The main difference is that there isn't the convexity in a vol swap that exists in variance. You can think of a vol swap as variance without the squaring effect, or a better way to think about it is a vol swap is like owning a 1-day at the money straddle every day that resets wherever the spot is. I would say in 2013 or 2014, the single stock VAR market probably started to get active again. People putting dispersion trades on in variance form, single stock versus index. But I think even in small pullbacks, even in October of it would have been 13 or 14, I think October of 13, we even saw dispersion guys get stopped out on trades. So people are still pretty nervous about variance in general. In terms of the liquidity or the size of the market today versus '08, I don't have an actual number. I can tell you that the market is much smaller now than it was in '08. The sellers of variance, generally speaking, are the large, Berkshires of the world, the large hedge funds that are looking for yield, the PIMCOs of the world sell variance because it's basically like selling rich insurance, while obviously people buy the protection for obvious reasons. Let's see, what else can I tell you about the size of it? I don't know, Joe. What else can I answer? Oh, so in terms of Vega, like I said before, '08, it would have been pretty easy. I would have said like when I traded variance, I would have probably traded 100K at a clip. That probably dropped to 25 to 50K in um, in 2009, 2010. That's not to be able to say you couldn't trade 250 or 500,000 Vega on a trade, but again, this gets into where the real vol players were, 3, 6, 12, 2 years out in Vega terms. I mean, it wouldn't have been unusual for, like, for instance, I would have had like a dispersion book of 5 to 10 million short Vega and index, and 5 to 10 million long single stock Vega against it that you can accumulate over time. But that would have been a reasonably large position. But yes, I would say today you probably see variance trade 100K at a clip. And again, that's in Vega terms. So, to equate that in terms of, an option, let me just pull up a 6-month option. I'll just give you a ballpark estimate here. If you were to pull up like a SEP option, if you were to buy 100,000 SEP at the money calls, let me see here. So yeah, buying like 1,000 SEP calls would be like 56,000 Vega. So not a ton. So 2,000 would be about 100,000 Vega. Um, let's see what else. Does that answer your question on the size of a trade? Okay. All right. I don't want to keep this too long, so let's get into the next part. So I had a few people ask me about pin risk on expiration and why stocks pin on expiration. This gets back to kind of the gamma discussion, or the gamma on expiration discussion we had in the past. Um, Generally speaking, you will look for pin risk in names that have perceived liquidity issues, which I would say is a strike that you're trading near that has a tremendous amount of open interest and/or a lot of open interest compared to liquidity of the underlying stock. Um, what basically the easiest way to think about it again is um, first, if you're long an option and you're long gamma, as you get closer to expiration, you're going to scalp that gamma for shorter and shorter increments. Um, as you get closer to that strike price, it's going to be shorter and shorter increments. So to use the example we used before with let's say an option expiring 10 minutes from now and you trading right at the strike, if your call goes in the money by a penny, you're going to sell out all your long delta because it's expiring. Conversely, if it now drops a penny below the strike, you're going to buy back all your short delta because you're now going to have a zero delta. So you're basically going to keep going back and forth doing that as the stock moves a penny above or a penny below right on expiration, and it's why it's likely to pin that strike. Now, people might ask, well, how close to a strike do you need to be to pin it? There's no real science to it. Again, it becomes a function of liquidity, open interest. Is the stock gravitating towards that strike? Is there news out? Anything else? But if it's more or less a feel sort of thing. So it's pretty easy from a long perspective why it pins it, but from the short perspective, people wonder, well, what do you do on the short side? Well, on the short side, if you short that option and it's expiring today and it's near the strike, you're massively short gamma. If you trade very short gamma, you pretty much chew yourself up, because as the long option holder is selling the stock a penny above and buying the stock a penny below, you would be doing the exact opposite, buying it a penny above and selling it a penny below. So basically just sitting there all day long, chewing yourself up, negatively monetizing your position. So to some degree, your hands become a little tight on expiration, and more than anything, you actually would probably trade the position less until you get right to expiration. The rule of thumb, generally speaking, if you're short an option on expiration and you think it's going to pin, you usually use the 50% rule of thumb in terms of how many options you think are going to be exercised against you. But you can also usually get out of the position for a small premium as well if you don't want to take that risk. But again, like usually speaking, you can use 50% as an idea as to what percentage of short options are going to be exercised. That can obviously vary, based on single stock names. And then the only thing else I would say is, if you blow through a strike for some reason, if there's news or something over the course of the day, you can actually see the pin risk work against you. It can actually create a gamma explosion per se, because everything's sort of gravitating towards that pin. But let's say news comes out and it pushes the stock above the pin price. Well, that guy who's long those options now no longer has any more stock to sell. and the guy who short those options now has to cover drastically, and it's a situation where you can actually see the stock rip because that guy's covering. So that's just something to keep in mind as well when there's intraday news on a stock that could potentially pin. And then I just wanted to lastly go into to early exercise of options. As a rule of thumb, you never want to early exercise a put option. Now there can be some financing reasons why you may or may not do it, but generally speaking, we're not gonna. It's not even really worth considering early exercising put options until we have higher interest rates in the market. The reason you would exercise a put option early if interest rates were say 4 or 5%, there can sometimes be a cost disadvantage to not early exercising a deep in the money option because of the carrying cost of the position. So, but generally speaking, you're not going to early exercise a put option. In terms of call options, you're usually only going to early exercise a call option for a dividend related reason, and that's usually going to be the day before an option goes ex-dividend. The key to remember when looking at whether or not you should exercise a call option or whether or not it's going to be exercised against you or whether you should point it out to your customer is, and what I usually do is I look at the respective put on the in the money call option first. And if you recall when we used to run the early exercise screen, this is basically the exercise that we used. And I'll go into detail on that right now. So I'll give you an example of a stock that's going ex-dividend tomorrow and what your options are and what you shouldn't do and why you should do specific things. So let's use the example where the stock goes ex tomorrow. You're long a call that expires a month from now. The calls are struck at $100 and the stock is at 110. Right now, the respective $100 put is 15 cents at 20 cents, and the company is expected to pay a 50-cent dividend. The worst thing that you can do is do nothing, because if you just own a call, basically you've got let's say you have a 100 delta call, your call's worth $10 today. Well, stock drops 50 cents tomorrow when it goes X, your call's now worth $9.50 and you lose 50 cents. Period. End of story. Remember, owning a call does not give you the right to receive a dividend, only if you exercise it. So that's the worst thing that you can do. Some people might say, well, what if I sell stock against my long call position? Well, think about it mathematically. What happens? You're going to lose the 50 cents on the calls again because the call options will drop by 50 cents, but you make 50 cents on the short stock because the stock drops by 50 cents. However, you're forgetting that you also have to pay that 50-cent dividend out to the holder of that long stock. So again, you net lose 50 cents. The other thing you can do is look into reversing a position, which in theory you could sell the stock, as I mentioned above, and also sell puts. So you would be left with basically long call, short stock, short put, which could make sense depending on where the puts are trading, but in this instance, it wouldn't make sense. The reason for that is you would lose 50 cents on the options, you would net out the 50 cents on the short stock, and you would only collect 15 cents on the puts that you sell. So net, you're going to lose 35 cents by not early exercising that option. What else can you do? You can roll up your long call if you want to still maintain that capped exposure. You can roll up that long call to a call strike that has an equivalent put strike value of more than the dividend. So what I mean by that is that when you early exercise a call, you're basically more or less saying that you're not willing to you're not willing to buy the downside put for the price that's listed there because you want the dividend. So walking through example will make the most sense. So let's say your option strike has an equivalent put strike worth $1. If you early exercise the equivalent calls, you make your 50 cents on a dividend, but you're basically saying that you'll sell that put at 50 cents, for which people are paying $1 for in the market. The easy way to think about this is simple put call parity. Short puts are selling the put is the equivalent to a long stock and short call position, which is basically what you're doing by exercising the call. So that's why you will effectively look at the equivalent put strike for idea as to whether or not an option is exercisable. Now, there might be a reason why you don't want to early exercise. So here's an example where let's say the put premium is trading near the value of the dividend. So you have to factor in things now like dividend withholding. Again, most hedge funds are offshore or have portion of their holdings offshore. So if you collect 50-cent dividend, that doesn't mean that 50 cents flows into their fund. That means it's 50 cents less some tax withholding rate, depending on how much offshore money they have. But in this instance, let's say that the put's at 50 cents. But on an after-tax basis, if you exercise that call and collect 35 cent or collect 50 cents, you're really only keeping 35 cents on an after-tax basis. Well, in that instance, even though the put is worth the same amount as the call op, or the put is worth the same amount as the dividend, you wouldn't early exercise that, because on a net basis, you're going to lose money. So what's the best decision? If you want the delta, don't sell the stock on the early exercise and exercise the option, but that's going to leave you with with unlimited downside exposure because you're now long the stock. So that's why you get into the option that I presented above, where you can roll up to a higher strike call option that isn't an exercisable call option. If you don't want the delta, you probably already have the position as a delta neutral position, and what you basically need to do is just true up your delta. So put your options on a 100 delta and just elect to exercise early. But again, the thing to remember is if you early exercise, you're basically saying you're okay not owning that downside synthetic put. And that's all I have on that. Are there questions now on any of those three topics? Give you guys 30 seconds or so. To answer your question, from a cost perspective, probably not. That being said, you can trade the expiration print, at which point you would be pretty much guaranteed the print, the SQ print every month. So you could do that, and that would be an instance that we could trade at the same cost. The banks do have a reasonable bid ask, so depending on the liquidity in the market there at a given time, we could certainly compare what it would cost us to what it would cost them, or what the bank would charge them. I think the main reason the main situation where you're going to be able to get someone to trade this with us versus a dealer is when they either again have OTC concerns, or they want to create, sort of a different structure than they would get with the bank, or they may not necessarily be able to actually trade it in their fund on a quote unquote variance basis. So, admittedly, I think it would probably be a difficult sale for most people, but I think, at least being able to put it out there and, talk to guys about this and, have them understand that we understand how to do it, is a value add. And also, you can tie it back into things like when we talk about 90% Russell puts and how it's similar to variance, and, kind of tying it in as a, educational exercise as well. So I would be kind of lying if I said, we would be able to do it at a much cheaper price than the banks, because it's probably not very likely. But again, there are reasons that we could potentially do it. Yeah, understand the products obviously important. I guess the other thing too that might be advantageous, or the guys would have to see how much margin they put up, um, in the instance of either buying or selling variance with the dealer versus how much margin they would have to trade buying or selling the listed form with us. But that would be something that they would have to check on their end, because it's going to vary fund to fund. So it might be that, they can just get way more leverage trading it listed with us than they get with the bank. Any more questions?